for operators like that, that's us. The other thing is that we can usually self-fund these deals. We don't have to have investor partners. And I think that that makes a big difference for people that are considering investing, like knowing that there's on the other side of the fence, the other team has something to lose. And we would have a lot to lose, probably a lot more than some would in the space, because our reputation is fantastic. We've got a 4.9 out of 5-star rating on all the review platforms. So I've been humbled by over $100 million worth of deals coming through our business, like humbled. And we get to manage these kind of resources for our clients. It's taken nearly 2 decades to get there. And I'm going to be brief with this. And this is important, okay? Number one, you have to have disciplined acquisitions to do what we're doing. We submit over 100 offers to get 1 deal. Name a team that does that. We do. You have to have world-class operations. I know that when everything was going up, even the rookies looked good. They covered up their bad mistakes because it was going up so fast. Nowadays, you have to have world-class operations. Insurance costs are up. Interest rate costs are up. Like, you got to be tight with your efficiency on the ground. We do that here. I would put up our team against anybody in the country for operations. The last thing is market timing. This is a little bit of a God thing, or maybe a good luck thing if you want to call it that. But market timing does make a difference. And when you've got people like John Gray from Blackstone saying that this is the time, you might want to pay attention to it. If you'd like to explore investing with us, go to homeinvest.com to jump on there. Now I want to get ready for the main event. I need you to type in the chat here. I need you to welcome to the stage. And I know that Zoom doesn't have a stage, but this is a virtual stage. And the more you actively engage, the more you actively learn, the more you'll retain. Studies show that you retain 92% when you're actively engaged. You only retain 51% when you passively sit back. So if you want to get a good ROI on your time here, then please help me welcome to the stage, Mr. Steve Werner. Woo!
What's going on, everyone? Welcome to another episode of the Opportunity Zone. We've got a lot of exciting things in store for you. Let's bring Nate up here as well. Saw him on here looking great as ever. Good afternoon, Nate.
Hey, happy Tuesday. Man. How you doing?
Good. How has your week been going so far? You're looking sharp as ever.
We have one of the most consequential Federal Reserve meetings happening right now, today and tomorrow. And I really think that we're on the tipping point of some real incredible deals being made, depending on which way this goes. We have forecasts for it, but we could talk about that today too.
Awesome. We have got a great show in store for you today. We're going to be talking about active listings are on the rise. So we've seen a lot of inventory growth. Even with the rate drop, we have not seen a big boost in sales. So we're going to be talking about that. Multifamily is starting to pick up across the board. We're going to be talking about that as well. There's still some great opportunities to get in. And we're also going to talk about 3 markets right now that appear to be bottoming out that could be great opportunities. We have a lot in store for you today. We always like to start off with wins. We want to celebrate Sue on our team. Sue has been knocking it out of the park. Nate, do you want to share a little bit about what Sue has been up to? I know she's on here. We're going to make her blush.
We put out a call to you, our clients, our investors, and we said, hey, look, we're negotiating more deals, but currently the only thing that we have is this lending opportunity, $1.5 million lending opportunity. And we put out the call, and within 10 days, you guys answered. Not only did you answer, but we had more people come in than we originally planned. So number one, thank you for your trust and your support. Those of you that took advantage of that opportunity, it completely subscribed, fully subscribed, 100% right now. We can't take any more money on it. But Sue knocked it out of the park. I don't know how you kept up with all the calls, Sue, but you did amazing. So good job.
Always awesome to celebrate somebody on our team. We also, as a win, I was on stage this weekend sharing in Idaho Falls. Always great to go share in front of people. Got to meet a lot of awesome people in person. Got to share a lot about what's going on in the market, where you should be positioning yourself. We also talked about how to save on taxes. It was a great event this weekend. And then the third thing, tomorrow we have something really special in store for you guys. We try to keep politics out of the show and just share the news, but we've had so many people asking us questions about what's going on with the political race, what's going on in these meetings. So tomorrow we have got a special edition that's going to be coming to you where we're going to be talking about things that are going on in the political race, how it's going to affect you regardless of who wins. We want to be very bipartisan and talk about both sides of the aisle. Nate, do you want to give us a small preview of that?
Oh yeah, with pleasure. So there's some major tax policies coming down the pipeline, and those of you that maybe you don't participate in all the political rhetoric, I don't blame you. I mean, it's gotten nasty, nasty. And as an adult living through several elections now, like I didn't think I'd see this in my lifetime, but here we are. And what I really want to hone in on, though, I want to get past the rhetoric and I want to get into what happens if Kamala Harris is elected. I think we kind of all know what would happen if Trump's elected because we've seen him. We've seen most of his proposals in the past. But economically, for us as investors, I want to just look at the brass tacks. I want to look at the real numbers. And I went back through 75 years of data to bring this to you guys. Did a ton of analytics on this. Our team has been working really hard on this. So tomorrow, we're going to unveil this. We're going to go through the step-by-step of what the 6 major economic and tax policies that Kamala Harris has on the table, how they would affect us if she is elected. So make sure you register for that. If you're not already registered, then we'll put a link in the chat for it. If you don't see a link because you're following us on social media, just type the word link in the comments, LINK, link, and our team will hook you up with the link.
Awesome. I saw Sue did put it in the chat. So it is in the chat here. I know we have a couple people on their phones. I saw a couple people zooming. You can click that link when you get home. Be safe with it. We'll get that in there a couple other times today, but that is going to be our political breakdown all coming tomorrow. So that's just a highlight of what we've got in store for you. We're going to go ahead and get this show kicked off. Nate, how do we start everything here at Home Invest?
Cool. So those of you, you might not share the same faith as us. That's okay. We still welcome everybody. But if it's cool with you, just let me know in the chat, type a yes. We're going to say a quick word, just a blessing over everybody that is viewing from wherever you are in the world, okay? Dear Lord, thank you for this opportunity for Steve and I to come and share and just bring real world economic policies, real world news, real world headlines that are affecting real estate investors. We recognize and understand that there's a lot of fear out there. A lot of people are making big decisions on where to put their capital right now. And we just ask that whatever we bring to light, that it brings out the best questions and it brings about the best information so people can make prosperous decisions for the future. In your name we pray. Amen.
Amen. All right. So let's go ahead and we're going to go ahead. Nate, you want to share about what our opportunity is? So I know you talked about we had closed out Pine Tree Path. What is our opportunity right now for people? If you're looking for a great opportunity to invest, what do we have for people today?
Yeah, I'm going to just do a quick little preview on this. So we're fully subscribed right now on our offerings. As most of you guys know that have partnered with us in the past, when we bring a deal forward, we underwrite it to the 10th degree. Like we're sending people on site, like we're doing a ton of work, and we only bring forward deals that are worthwhile. And so we don't always have a deal on the table. And right now we are fully subscribed on the deals that we have. Now, with that said, we are close to opening up 2 different things. We've got an industrial opportunity that will be coming soon. Those of you that really like cash flow, or maybe you participated in Cash Flow 7, you'll definitely want to be on board when we do open that one up. We can take soft commitments and do some verbal conversations about it now, but we're looking at another manufacturing industrial site in Dayton, Ohio right now. If you'd like to be included on that, then we'll put a call link up. You can book a quick call. We'll talk to you for 10 minutes and we'll tell you about it. I can't talk about it publicly yet though. I can't publish the pictures and images and all that kind of stuff yet because we are not fully under contract. We are under letter of intent, but not under contract yet. We have been on site. We love the deal. The other one I'm just going to preview, Steve, if it's okay by you, is this one's kind of special. We've been talking for a while about the potential of doing a generational wealth fund, which in my mind, it's wealth without taxes. And how do we accomplish that? We accomplish that by buying distressed assets at a discount. Nate, what does all that mean? What is that jargon you're talking about? Well, back in 2010, God put us on an interesting path. We started buying up these foreclosed houses at basically 70% of what they were worth. So we would buy them with cash, and then we would run to the bank and we would refinance them. And in a refinance, we would get all of our cash back. Imagine for a second if you could invest in something and get all of your money back within maybe a year or two, and then you still get to keep the cash flow forever. Well, those deals, they were here for a couple of years and then they dried up. Some of you might even remember buying some of those deals back in the day. And I'm really happy to say that deals like this are starting to emerge again. They're not easy to find. You have to look hard. You have to know where to look. But we have been pounding the pavement. We've been hitting it really hard. And the image I'm showing on the screen right now, I can't display addresses or anything like that because we're still negotiating this. But this particular deal is one that we might have an opportunity for you guys soon. And this is one that we'll put it out there as long as we get the contract with the seller. It's a multifamily property. It's in a very, very vibrant part of a growth market. You will absolutely love it once I can publish it. And if you're interested in something like this, the way that it would work is that you put your money in, expect your cash to be tied up for about 2 years, and then we're going to go back to the bank and we're going to refinance it. And we anticipate doing a full cash out refinance or very close to it. And then you get to take part in asset ownership long-term forever, or as long as we hold and own that asset. If that sounds interesting to you, if you'd like to be with a team that has done this thousands, literally over 1,000 times, if you'd like to be with a team that's been there and done that, then I'd highly recommend you jump on the line with us, get to know us, build a relationship. We'll show you some of our track record. And then as soon as this one comes, then you're ready for it. This one, when it does come, it's a distress sale, which means that the seller on it, they're discounting it so heavily just to get out of their bank loan. Great property, bad loan. They took out a bad bridge loan 2 years ago. And if we get this one locked up where I think we're going to get it, this will be the home run of the year coming around the corner for you. So if that's interesting to you, then book a call with us. If you don't see a booking link in the chat, it's probably because you're on social media with us. Just type call, C-A-L-L, in the comments, C-A-L-L, and our team will hook you up with a link. That's what I got, Steve.
Awesome. I love it. You know how passionate I am about generational wealth. I love helping people build wealth in their bank accounts and a wealthy mindset, then pass it on to their children. So super excited about that. Sue has put the link in the chat. We have both the booking link in there for you and the event for tomorrow as well. All right, we are going to go ahead and jump into the news. The first one that I am going to put up, let me pull this one over here for us. So right now we are seeing active listings going up. I'm going to share my screen. I mean, this is something that we've seen for a while, but we've seen this kind of explode over the last. This is the wrong one. Let's see if I can get the right thing up in front of us. There we go. All right. So inventory of vacant homes is going up. People are not buying even though rates are coming down. Nate, what do you make of this? What's going on in the market? Why aren't people moving?
This is a repeat. Those of you that are students of history and you like to look at what happened in the past to somewhat accurately predict the future, then be cognizant of what we're about to say. Right now, rates are coming down. They're dropping like a rock, but the markets have already priced them in and people are still not moving. So what does that tell you about confidence of buying right now? Buyers are on strike in the single family house markets. Buyers are absolutely on strike. They're looking around and they're saying, holy cow, it's so expensive. It's doubled in price over the last 3-4 years. And so I think that buyers are going to sit on the sidelines until we return to what we had in the past. Now, what does that mean? What we had in the past is that you could be earning 75 grand a year and qualify to buy a house. Today, because of, let's just call it inflation, that's what everybody likes to call it. It's really because we printed a bunch of money and assets had to go up in value. But today, you'd have to be making 125 grand to qualify to buy the average house right now. 75 grand versus 125 grand. That's in a 4-year window. And so I think that until prices drop or wages increase, I don't think we're going to see buyers moving. We'll see a little bit of stimulus as they drop the rate a quarter point here, a quarter point there, but we're not going to see a mass rush back to single family homes until people have the same buying power that they did 4 years ago.
So how do you think, like, what do you think is going to fall out over the next 6 months, Nate? I know we're going to talk about this some tomorrow. It's going to depend who gets elected, but what do you think is going to happen over the next 6 months, both with buying power? Because you've got, as inventory builds, we know what
Right.
happens. Prices have to shrink in order to get properties moving. I've seen a lot of realtors. We actually talked to one of our neighbors who was selling his house. His house has now been on the market coming up on 6 months. He hasn't had a showing in 3 months. He hasn't had any interest. He's dropped the price twice. His realtor has said, well, hold on, it's coming, it's coming, it's coming. The realtor's trying to get the relisting agreement. What do you think? Like, what's going to happen as inventory builds? Are people just going to lose all of their equity? How are we going to see this play out?
And Steve, what you're hitting on is probably the most important point of the day today. So take note on this, guys. So Steve's talking about Austin, Texas right now. We could also look at Punta Gorda, Florida. Steve, you're going to get a couple other markets we'll dig into today. There are some markets in the country right now that are dropping. They're starting to find that, they're trying to find that equilibrium. Remember, 4 years ago, people only needed to make 75 grand to qualify for the average house. Today, they got to make 125. Either their income has to come up or prices have to come down. That's the only way we're going to find that equilibrium. I think we're going to continue, Steve, to see what you just mentioned. We're going to see prices coming down in some of these cities. Now, it's not going to be across the board. I know people have been looking for like that giant 2010 correction where assets just drop like a rock. I think we already saw that in commercial. Not I think, I know. We can prove it with data. We already saw that in commercial, but with residential, it's going to be market specific. So in some of the markets like Austin, Texas, spots in Florida, et cetera, you're going to see prices come down. In the rest of the country, especially markets that are short on inventory, prices are probably going to stabilize and they might even come up still. So we're going to see some of both going on.
So just to dovetail into that, our next article here is 3 markets that are in deep trouble. These are the ones that are bottoming out right now. You hit on Punta Gorda. We'll come back and talk about that one because that is in your backyard. It's actually one of the first tipping points we saw back in 2007 and 2008. Now we're seeing that again. New Orleans, which I think is an interesting choice. And then Austin, Texas, which you touched on. I'm moving back there in about a week and a half. We've seen a lot of changes in real estate there. So these are 3 markets that you want to look at. Let's talk about Punta Gorda just a little bit, Nate, just because that's in your backyard and you have some very specific knowledge on that one.
Yeah, knowledge, and we're receiving leads. We got 2 leads from that city about 2, maybe 3 weeks ago now. And our friend and partner, Mike Mangham, is working those leads right now. Like there's sellers actively calling us saying, please come buy my house because they can't get a buyer. Buyers are on strike. We're seeing listings in Punta Gorda right now that were listed for 450. Literally one of them that we're tracking, the sellers got the price cut now down to 270, 430 to 270. Imagine that, still doesn't have a buyer. Punta Gorda is not at bottom yet. I think they got a ways to go. They came up way too fast during COVID and they've got to find equilibrium.
Let's talk about Florida just a little bit, Nate, because I know one of the questions we get a lot of times, people are like, hey, do you have a multifamily in Florida? Do you have something in Florida? There are a couple things that you need to keep in mind when it comes to investments in Florida. The first one, of course, is insurance. Yes, a lot of people want to move here. Yes, there's no income tax. It's a great place to live. Nate, you love living there. Keeps your hair nice and fluffy with the humidity. I don't have that problem. But what should you keep in mind? Why, should people be investing there? Should people be looking there? What should they look at to be safe investing in Florida?
Yeah. Florida's fantastic, but under the right numbers. Now, we've done a lot of deals in the state of Florida. We did them when they made sense to do them. What's happened recently is that insurance rates went through the roof, just like Steve is educating us on now. Like insurance, that's usually one of those line items that doesn't move very much when you're doing your numbers on a spreadsheet, but insurance moved a lot in the last 3 years. Ever since the hurricane slammed the southwest coast of Florida a couple of years ago, insurance providers, some of them got whacked, some went out of business, and the other ones that have remained, they jacked their rates up through the moon. And they knew they could because there was less competition. Now, some of that has started to calm down again. What you got going on, though, is that some sellers They took out their insurance policy 3 or 4 years ago. They've just renewed it and they've been able to lock in these lower prices. And if a new buyer comes in, what do you think happens to their insurance rate? Are they going to pay the rate from 3 years ago, or are they going to pay today's rate? And because they have to pay today's rate, what's happening is a lot of the deals fall apart right there. The numbers just don't pencil and the sellers get frustrated and they're like, I don't understand. We've literally submitted over 40 offers, closely evaluate, and either made a verbal offer or a written letter of intent on these 40 different multifamily pieces of real estate. And it's been tough to get one in the last quarter or so. We will strike in Florida. We're just going to do it when the deal makes sense.
Yeah, that's the biggest thing. We have to make sure that the numbers work out. And this is what you're going to see. You're going to see prices start to fall because some companies, some of the people that took the loans in 2020 and 2021 are now getting their backs against the wall. The insurance has gone up on them. They're not profitable and they're going to have to move the property. We're just waiting for the right one. I know you guys listening to this have probably heard us say this 100 times, but we underwrite around 100 properties a month. And we do a lot of due diligence to bring only the best deals. We're one of the few syndicators I know. We do a couple things. The first one is we pay dividends as soon as humanly possible, which is usually the first quarter after we own the property. The second thing, we pass the tax savings on to the people that are investing with us. We want to make sure that you guys get the tax advantages through a cost seg study. Those two things make our deals really profitable. The third one is all the underwriting that we do to find only the best deals. We don't use an adjustable waterfall, which means you as an investor get paid the same throughout the entire deal, which makes it profitable for you. We would rather have you guys make as much money as possible because we know that you will either refer people to us and or you will continue to invest with us when this investment comes to fruition. So that's why we haven't struck in Florida yet, but it is coming soon. So now that we're talking a little bit about commercial and multifamily, let's move into the news over there. This next one that I've got for you, this one's kind of interesting. So it shows that commercial mortgage debt hits 4.7 trillion and delinquencies are the highest they've ever been. Nate, do you want to talk about this one a little bit? We've kind of talked about what's going on in the commercial market. It's continuing to go down. They're continuing to have trouble. We were talking about this a little bit this weekend at the event that I was at. So many people, their leases are coming up now, and big corporations aren't renewing their leases. Facebook just announced that they are pulling out of Austin altogether. They built the building. They housed some of the floor, some of their office there, and now they've decided to pull out completely. We're seeing a lot of businesses, they were fighting over whether or not they're going to continue remote work or not, and they've decided to continue remote, and they are shutting down offices. What does this mean for investors?
Yeah, and Steve, this is just the tip of the iceberg. We're not seeing all of the actual distress that's out there yet. It's still working through the system. So Steve's hitting the tip right here with this $4.7 trillion of debt. It's the wall of debt that's hitting the commercial market. What's it from? You guys remember during COVID, the government said you can't go to work. You got to stay home. You remember that a lot of businesses ended up shuttering. They closed their doors. A lot of businesses went under. And the businesses that did survive, a lot of them reevaluated their office space. I spent this last week in Chicago, where we had our office for years, downtown on Michigan Avenue, overlooking the river. Beautiful. I just got to go see it, and I took my son to it to remind him when we had our office there. And I remember why we canceled the lease at the end of the lease. Companies no longer have to have that big square footage frontage. Companies nowadays, they've figured out this hybrid model where they can work from home. And let's face it, ladies and gentlemen, we're not going back to the way things used to be. Nowadays, Zoom is a more powerful company than you've got with some of these WeWork type office places. Zoom is way more powerful. So with that said, you're going to see a longer pain period, more ripping off the Band-Aids of some of these banks that took out, that lent money on commercial real estate. Offices are going to continue to get hit the hardest. Multifamily already took its tumble, in my humble opinion. I have a lot of fact on this, but multifamily already hit bottom and it's already correcting, but offices have a ways more to go.
I think offices still have a long time to go. I think we're going to see somewhere. This is my thought, Nate. I would actually love your 2 cents on this. When I look at my crystal ball, let's be real, like all of us are looking at a crystal ball in the future. What I see happening is eventually there are going to be a couple companies that become really good at turning ex-corporate buildings into housing. There was one we were talking about this weekend where the company came in, they took the bottom 4 or 5 floors, they reinforced them with concrete, they turned them into a parking garage, and they turned the 24 floors above that into apartments. And they bought the building for so cheap. They bought it for 10 cents on the dollar. They were able to do that as a syndication, as a rehab project, and turn it into an A-class housing project. What do you think about that? Do you think we're going to see a lot of that?
I do, particularly when the government is willing to do a private-public partnership. We saw it in Detroit. Detroit had a lot of vacant buildings, office buildings downtown. 2 years ago, they started their downfall. And the city got involved and they got federal funds to give to a big developer. And the developer was able to basically come in for no cost to buy the real estate, but they had to raise money and bring capital for redoing the real estate, fixing it into housing. So I think if we see more of that, yes. Some of the office space right now, it would be cost prohibitive to convert it into residential. Meaning, think about this, like office building, giant shared heating system, giant shared cooling system. Electricity is per floor. You come in, you got to get 24 apartments on that floor. Now you got to rip out the electrical out of the wall. You got to rip out the plumbing and you got to redo it all so that you can have an individual meter for each of the apartment units. So sometimes that cost gets really, really big. So that's why I say, I think we'll see more of it if there's more public-private partnerships. New York has a proposal on the table right now that they're trying to get through for New York developers to convert office space into housing as well.
Yeah. I think we will see partnerships. We're going to have to, because otherwise we're just going to see this empty office building. Zoom user asked, really, Facebook, they're contracting or consolidating? I think what they're doing, I don't know. I didn't talk to them, but my guess is that they have a lot of people that are working at home. Nobody's coming into the office. They don't need the office space, and they're paying a prime price for those offices in a high-rise building in downtown Austin, when they can say, you know what, we're going to let people stay at home and we're just going to put that money back in our pocket. You saw Salesforce actually do this in Chicago recently as well. They pulled out of one of the biggest buildings down there because they don't need that much floor space and they don't need the name on the building. They're looking for profitability and they're answering to their shareholders. At the end of the day, they're looking for where they can eke out, especially in this economic climate. That actually, though, Nate, you were talking about multifamily, brings us to our next and final news article of the day. After 2-year slump, multifamily metrics are ticking up. We are seeing them grow. Nate, you were talking about, you thought that multifamily had hit rock bottom and turned the corner probably a month ago. We started talking about it here. I know we were talking about Blackstone. Talk to us a little bit about what's going on. What are these metrics and what are we seeing happen in the multifamily market?
Yeah, you had four, and count them with me now. I'll go through all four. You had four headwinds that kept multifamily back the last couple of years. It actually decreased multifamily house prices for the first time in like 14 years. Multifamily prices went down for the last 2 years. Here's why. Here's the four. Number one, interest rates went up. Whether we like it or not, when you buy something with a loan on it, when the cost of the money goes up, the value of the property goes down. It's just, it is what it is in multifamily investing. It's not like a residential house. Most decisions are made off of the net income that the property can produce. If the debt costs more, people are going to pay less for it. The second thing is that taxes have gone up a lot. A lot of counties around the country, even Texas, which surprised me because Texas has been so landlord friendly for so long, Texas nearly doubled some of their property taxes. So you saw this big tax increase. The third one is insurance. You guys know what happened in insurance because we talked about that already. Insurance rates doubled and sometimes tripled in rates overall. And then the fourth, when you layer this together with the fourth one, which is rent starting to get saturated, Yes, that's right. Some markets, we've seen rents actually go backwards a little bit because people got the hype and they took advantage of COVID and rent increases and all that kind of stuff. Rents going backwards causes that net income to dip. Therefore, it's pushed prices of multifamily down. Multifamily real estate, if you compare it on a national basis, I can't talk about specific markets unless we talk about the markets that we invest in, but on a national basis, the multifamily valuation is down about 35% from where it was 2 years ago. Imagine this, okay? Those of you that are interested in that generational wealth fund that we talked about, where you can invest and then watch us do our project and then refinance money back, watch this. The seller, literally, I'm going to put it up on the screen because it's kind of a powerful example. The seller on this literally paid $5.7 million for this property right here. Okay, I can't give all the details on it yet because we're still negotiating, but they paid $5.7 million for this 2 years ago. It was rented at the time. They got a little crazy and they went in and they tried to convert it into the whole traveling nurse short-term rental thing. Big mistake. It is what it is. And eventually what ended up happening is that now they ran out of time. They were 2 years into it and their debt is expiring, meaning their loan had a term limit of 2 years. And now they're forced in this awkward spot of saying, oh crap, our business plan didn't work. What are we going to do? And so they're having to sell it at a major discount. They're basically selling it for the loan value that's on the property. Imagine that. And so a team like ours that understands that long-term tenants are much more valuable, we can come in and we'll stabilize the property. We'll come in and we'll put long-term tenants in, and we'll be able to get through the headwinds that they created on this property and make it into a nice long-term asset that produces good cash flow for us. But that's where the market's at right now. Multifamily is down 35%. So we're buying. In my opinion, mark my words on this. Someone please record this. You'll see it because we're on social media. Come back in 2 years and you will see multifamily hit rock bottom right here in 2024. Multifamily hit rock bottom. This is your time to grab good deals right now.
Where is the property? General location, Nate?
I promise I will, you guys will be the first to know right here on this show. We will get that out. Well, first we show it to our existing investors and then we open it up to this show. If you're an existing investor, you will hear about it right away. Or if you book a call with Sue, she might whisper part of it. We can't give all the details yet. Sorry, we signed an NDA with the seller and we're still negotiating some of the terms. As soon as we can publish it, we will, but book a call with Sue. You can chat with her and then you get on the first to know list and we'll let you know as soon as we've got it. This one, it will move really fast. I'm not saying that as like hype or anything like that. It's because it's going to be a sensitive sale. Once we come to the term with the seller that everybody agrees on, which we're very close, it's going to be like sign it and close it within 2 weeks kind of thing. So it's going to go really, really fast. I will personally fly in. I'll probably meet our COO, Rodney, out there with his inspection team. We'll walk the property. We'll audit the leases. We'll do everything we need to do due diligence wise. And then after we give it a thumbs up, then we're closing on that thing.
I love it. All right. So we just went through all the news, and that last article that I showed, I just want to go back to this really quick, if my computer will cooperate with me. There we go. You'll see down here, it talks about cap rate. So I thought this would be a really good moment to understand what cap rate is and how this affects you. Like, this is what cap rate allows you to do is compare apples to apples instead of apples to oranges. So Nate, can you give us a very quick breakdown and show us how to come up with cap rate so that we can compare apples to apples? I know I saw you flashing around the marker and you've got that nice drawing board behind you.
Yeah. Is it cool if I answer one question and then I'll get back into cap rate in just a second? So I probably may have said this in a confusing manner. Lori's asking, when you say 2 years, multifamily will hit rock bottom. What does that mean? So Lori, what I mean by that is that we actually hit bottom already. I think history will prove this to be true within 2 years that we already hit bottom. I'm already seeing it in the data that I look at. Blackstone, which is the world's largest landlord, they have more money in real estate than anybody else does. They've been buying like crazy. They've deployed a couple $100 billion with a B dollars in the last 4 months to buy multifamily because they think we're at bottom right now. So it's not just Nate's theory. It's not just me, hoping and praying. This is actual like big institutions moving money and the data that we're seeing. I believe we hit rock bottom already. And now from here to the future, I think we'll see multifamily come up. Now, we can't confuse that with office space. They get thrown in the same bucket under commercial real estate. So sometimes you'll just hear, well, commercial struggling, commercial loans, this. And yes, commercial in general is going to struggle for a while until we get out of this, if you want to call it a recession or whatever it is. Until we get out of that, commercial is going to be a pain point. But multifamily specifically, we hit rock bottom. We're on our way back up. I hope that clears up that. Sorry to confuse anybody if I did.
Cool.
Okay,
So
you want to do cap rate formula now?
Yes. Let's take people through what cap rate is and how we figure out what it is.
Yeah, so I'll back up back here. We'll come back to this lovely whiteboard, as Steve calls it out. Let's see, my camera will zoom into it. So cap rate's really simple, okay? As the whiteboard gets zoomed in on, cap rate is net operating income divided by current market value. So I'll put it right here. You guys can write it down. NOI divided by value. Now, NOI is pretty easy if you understand what each of these letters represents. It represents net operating income. Net operating income. What does that mean in 10-year-old terms? I got a 10-year-old son named Bianco. I took him to the conference with me last week in Chicago. Bright kid, but I still talk to him in 10-year-old terms. So I'm going to talk in 10-year-old terms. NOI means what is the bottom line net number of income that's coming in? Okay, so as an example, we own a 78-unit building in Louisville, Kentucky. On that particular property, we've got parking that generates $50 per month. We added that after we bought it. That was a huge NOI booster. We added $50 per month for all the parking spots inside that building. Huge, huge cash flow boost. We've got laundry income. We've got pet income. When a tenant decides to add a pet to their lease, we charge them for that. We charge a deposit and we charge a per month rent fee. All of those things boost the top line number. Now, to get NOI, which is net, you have to take the bottom line number. So you take all of the income minus the expenses. You're talking property management, taxes, insurance, etc. All of the income minus the expenses, that is your net operating income. On the property that I flashed on the screen for just a minute, the net operating income would be calculated like this. You got a whole bunch of units. I'm going to make this number up because I can't give the specifics on that deal yet. 20 units. Let's follow the math together on this. 20 units. And let's just say that the market rent is $2,000 per month, which it is. These are really big units. It's in the hottest area of that city. $2,000 per month, 20 units. I'm going to discount that because I don't want to have to wait around to fill a building. I want that thing to be filled right now. I'm going to discount that to $1,600. So in a market where something usually rents for $2,000, if I rent it for $1,600, I'm going to fill it like pronto time, no time at all. I'm going to go 1,600 on my calculator right now. You guys can follow along with me. 1,600 times 20 units. You can see here that I would collect about $32,000 in gross income that month. Now I'm going to multiply that times 12. Why? Because there's 12 months in a year. This will give me the gross income at the end of the year, $384,000. Okay. Now, how do we figure out the expenses? Well, the best way is that you look at the actual expenses that the seller has. You look at their Schedule E, their tax returns. You look at their P&L, their profit and loss. You look at their T12s, which stands for trailing 12 months of income and expenses. You look at everything. You leave no stone unturned until you literally have a full financial picture. That's the way that we do it. Is it hard work? Yes, but you got to do it. And then you'll figure out their expenses. Now, on a building like this, it's usually safe to assume, and I'm going to do this just for illustrative purposes, it's usually safe to assume that about half of the annual income will go towards expenses. So I'm going to divide this by 2, and you'll see that it equals $192,000. Okay. 192 is our NOI. Okay, that's how you arrive at that number. NOI right there, we get it together. Now, let's take this a step further so we can get full cap rate on this. We have to take NOI divided by value. Well, what is value? Is value the market value? Is that an appraisal? Is that what the seller wants? How do you determine value? All of those questions that I just rambled off, they can be true. To simplify things, let's just pretend that the seller's asking price is value. Let's just pretend that they actually know how to price their building. Now, insider secret, they're usually overpriced. Almost every single one of them is overpriced. Steve's laughing because he knows this game. Steve's bought 50 plus properties on his own and he knows they're all overpriced. But I'm just going to pretend that that's value, okay? So on a building like this, we had $192,000 as net operating income. I'm going to pretend that the seller on this one wants $3 million bucks. So what I would do is I would divide this right here by 3 million. Divided by 3 million. So you can see on the calculator what that looks like. Divided by 3 million. And you'll see that it's 0.064. You move that decimal place over to, it's a 6.4 cap. So on the example that I just gave here, this is cap rate. On the example we went through together, this one comes out to be about a 6.4 cap at today's numbers that we're using on it, okay? So that's how you come up with capitalization rate. And you can work that formula backwards. Those of you that remember algebra from back in the day, algebra says I can move one of these to the other spot. So let's just pretend that I don't know what the seller wants, but I know what cap rate should be in the area. You can move one of the variables around. I won't get into all that fancy math right now, but that's the premise and how you can work with cap rate.
So that actually gives you your offer price. If you know that it should be a 6 cap, you can work backwards to figure out what your offer price should be on the building. So Nate, the other question that I have here, A-class properties, B-class properties, C-class properties all have different ballpark cap rates. Can we just give people an idea of what those would be? What would an A-class property be?
Yeah. So A-class generally, it depends on where we're talking about. Like we have a oceanfront property in Florida. We submitted an LOI on it, letter of intent, and I thought we were going to get it. The broker actually called us and he was like, I felt like he was wearing our team jersey. He was wearing Team Home Invest, your home for investments. He was like saying, oh, this is going to go through. This looks good. And then he came back and he's like, oh, you're in multiple offers. And I'm like, it's not even listed. How did it go to multiple? Anyways, that particular one, I put that, even though that's class A, waterfront, ocean, literally beach access, private beach access right in front of this multifamily. I put that one through our underwriting at a 6 cap. And I thought for a second, we actually had a chance to buy it at a 6 cap. What it turns out is that it went into multiples and there were people that chased it all the way up. They increased the price so much that the cap rate had to come down to somewhere in the high 4s. I don't know exactly what it sold for, but it sounds like it's south of 5. So what is class A real estate trade at? It might be a 4 cap. If it's in a really, really good area and it's a new asset, it might be a 3 cap. You can't really pin that, but I would say somewhere in that range, 3 to 4% cap rate range.
Okay.
B-class assets, should we do those?
Yeah, go for it.
Okay, so B-class, that's like instead of front row, oceanfront, prime new, that would be one step down. You're still dealing with upper level management type positions, usually white collar, newer, but not brand new. There's a lot of shops in the area that are nicer, they're higher end, but not the highest end. That kind of stuff, that would be called B-class. And B-class is probably going to trade, depending on the city that we're talking about, somewhere between 4 and 6% on the cap rate, 4 and 6.
Okay, so you guys see the trend here, right? A-class properties are going to have the lowest cap rates. B-class are going to be in the middle, and C-class, Nate, what do we get with C-class?
Yeah, C-class, this is working class housing. This is not your gunshot zones. Let me be very clear about this. I was in Chicago. I don't want to pick on Chicago. I love Chicago. I lived there for part of my life. One of my kids was raised there. Like, I love Chicago, but Chicago makes the news all the time for like gunshots and things like that. Well, here's the thing. There are parts of Chicago that are A-class. There's parts that are B, there's parts that are C, and there's parts that are D and F. The D and the F stuff is what you want to run from. That's where we're not going. That's where the trouble is. C-class is so different. So different. C class is your average working class families, people going to work every day, people that want to make a paycheck and do better for their family. C class is a great, great housing stock to invest into. We've got different options that we bring in for different reasons, sometimes for tax reasons, sometimes for cash flow reasons, but C class is your working class housing stock of America. C class provides the highest, but in my opinion, the safest returns. So what do I mean by that? C class, you can buy anywhere from a 6 cap to an 8 cap and still be in a really good area. If you start getting like 9 caps, 10 caps, when I say cap, I mean capitalization rate, cap rate. When you start getting into those really high numbers, I would really question the area. I'd look twice at it and I'd say, why is this a 9 cap? A good solid C cap should be somewhere between 6 and maybe 8%.
All right. So the thing that I want you guys to take away with this is cap rate is much more important than purchase price. When you're looking at an investment, you want to know what the cap rate is, because that tells you how good of an investment it is, how much return you are going to see. The reason that A-class properties, Nate, can we talk a little bit about why A-class properties, beautiful oceanfront, great amenities, but they have the lowest cap rate? Why would anyone invest in those?
Yeah, number one with real estate, and we're going to cover this tomorrow a lot, taxes. Who here would rather not give the government a bunch of excess taxes? Just type yes in the chat, or if you're following us on social media, just type yes if you'd rather not hand over a bunch of extra money. I'm all for paying our fair share, right? Give to Caesar what is Caesar, give to God what is God's. But there's nothing that says in the tax code that you have to pay a tip. Nothing says that, okay? And so in real estate, we are given one of the greatest tax gifts of all time. You see, they recognize the IRS tax code. It was passed into law and they've modified it, they've amended it. There's 4,000 pages, but inside those 4,000 pages of tax code, they understand that to get people like you, to get people like Steve, to get people like me to invest our money into real estate, we need some trade-offs. They understand we're creating jobs. They understand we're providing value. We're providing housing. And so they give us a huge trade-off, and it's called a tax benefit. You might hear the term called a passive loss. Write that one down or commit it to memory. It sounds like a scary word, but it's not. At least the first time I heard it, I'm like, loss. I don't like losses. It's funny. I was having a business discussion about buying or selling some equity in a business with a partner. And I had told him, I said, I cringe thinking about losses. Like I don't want to run a company that way. Like I want to run my companies with positive numbers, making money all the time for everyone. And so I cringe when I hear loss. But a passive loss is different. A passive loss is on paper. All that it is that when you buy a piece of real estate, because the IRS tax code is the way that it is, you get credits. I shouldn't call them a credit. It's legally called a passive loss, but I think of it like a credit. You get these essential, they call them passive losses. And so what I do, Steve and I bought that 78 unit building. We got $978,000 of passive losses that we got to use against our other income sources. So for me, as an example, people will sometimes hire me to consult for them, to look at their real estate business, to help. Steve has done a ton of that too. And instead of me paying taxes on that income, I can take my real estate passive losses and offset it over here because of the way that I file my taxes, the way that I structure it. And so if you don't know about these things, you really should know. Either have a conversation with a CPA or jump on the phone with our team and we'll hook you up with our CPA. But there is a beautiful, beautiful tax savings plan. So on average, like for me, if I put in $1, our multifamily deal, Steve, that we're closing next week, beautiful property, brick building. For every dollar that we put into that thing, we get 41 cents back as tax credits, essentially. It's called passive losses, but I think of it like a tax credit. So put $1 in, get 41 cents back on my taxes. I will take that investment all day long, plus cash flow, plus appreciation. The tax incentives alone make it the best.
Awesome. All right. So there you guys go. You have the overview on cap rate. It is what you should be using to analyze your properties. I want to put a big asterisk there. just so you guys know, if you're looking at listings, if you're looking at LoopNet or Crexi or any of those, and you happen to see a really high cap rate on a building that looks really good, it's because the broker probably didn't know how to figure cap rate and the expenses are off. That's the biggest thing. You have to make sure that the expenses are somewhat correct. We aim to have you able to figure cap rate in 5 minutes or less. So you just want to go over the expenses that they have listed. They probably didn't fill something in if cap rate is really, really high. But as a rule of thumb, the higher the cap rate, the better your return is going to be, which means it's better. But if it gets too high, then you know that either they didn't fill in the information or it's in a war zone. Those are just some good rules of thumb. Anything else people should know about cap rate, Nate?
I think you nailed it, man. I would just say kind of in closing, and I'll let you finish this off, Steve, but I hope that you guys found some useful viewpoints today. Steve takes a lot of time to go through the news and go through what you guys are asking to really curate this show for you guys. We know that your capital can do more for you, especially through shared real estate investments or shared investments like we're doing here. So if you're an accredited investor and you're ready to start considering investing it into something that makes sense for you, then I'd encourage this. Please book a call with our team. That deal that I flashed up earlier, once we publish it, it'll go really fast. We want to build a relationship with you first, just so we can get to know one another. And we also encourage you to join in tomorrow's discussion. If you want to learn about the tax implications and the economic policies of what the next potential president might have, join us for that live show. But we appreciate you.
Awesome. So Sue has the link to book a call with us. Do we have anything for non-accredited investors? Yes, we do. Click the link that Sue put in there. We don't have an offering right now, but we do have offerings from time to time, and we want to make sure to pass those on to you. You can book a call with myself or with Sue. We're happy to get to know you a little bit, and then we'll put you on our non-accredited list. So when we do have something, we'll reach out to you with that. We do have those from time to time. If you are accredited, you can also book a call with myself and Sue. We'd love to talk to you, get to know you a little bit, and that will get you on for our next offering that we have for you. Tomorrow, again, the special political webinar that we are doing. We're going to be breaking it all down for you. Nate has done a lot of research. He's gone back 75 years and pulled all the data. He'll be going through that with you tomorrow. If you are nervous about the election, if you're wondering what this is going to mean for investors, Nate is going to do his absolute best to pull back the curtain and show you what to expect. That is tomorrow. The link to register for that is in the chat as well. It's about 3 posts up. It is homeinvest.com/event. And we will see you there tomorrow. Guys, it's been awesome hanging out with you today. Wishing you an awesome week. And we'll see you back here next time, next Tuesday, for the Opportunity Zone. Our goal is to help you practice everything that is talked about in Matthew 25 to be great stewards of what God has given you. Have an awesome week, guys. We'll see you soon.